Hey everyone, Albert Stepniak, your friendly real estate agent here in South Florida. So, wanted to chat about what's going on in the housing market. It's like, you know how sometimes you can just feel a shift in the air. Well, that's what's happening in Florida right now. Turns out, folks in Florida are feeling way better about their money and the economy than they have been in a long time. 3 years, in fact. A report from the University of Florida says their confidence is up, which is a big deal. It's not just us either. People across the country are starting to feel a little more optimistic. This is probably because inflation is finally cooling off a bit, and a lot of smart people think the Federal Reserve might even lower interest rates soon. That would make it cheaper for all of us to borrow money, whether for a house or a new car, which is great news. Now, while we're all feeling good about the future, the report did mention a few things that are still a bit of a bummer. For example, people are still less excited about buying big stuff for their homes right now, like a new refrigerator. It seems like everyone, no matter their age or income, feels the same way about that. But here's the cool part. When it comes to the future, Floridians are really positive. They're feeling confident about their own finances and the economy in the next year and even the next 5 years. This is a huge sign that people think the good times are coming and that things are going to get better. And that kind of positive thinking often leads to more spending and growth, which is exactly what we want. Now, I also saw another report, this one from the University of Michigan, that talks about how the rest of the country is feeling. And it's a little different. It seems like consumer confidence nationwide actually went down a little bit in August. People are a bit less sure about the current economic conditions, and they're more worried about inflation in the short and long term. This dip in confidence was pretty widespread, hitting people of all ages and income levels. So, what does this all mean for us? Well, it's a bit of a mixed bag. On one hand, we in Florida are feeling pretty good about the future, which is a great sign for the real estate market. When people are optimistic, they're more likely to invest in a home. On the other hand, the national picture is a bit more cautious, especially with people's concerns about inflation. But the fact that Florida is bucking that trend is a really good indicator that our local economy has some strong momentum. It will be interesting to see how it all plays out, especially with a potential rate cut on the horizon. Now let's talk about what's going on in the job market and what it means for us in real estate. The big takeaway is that things are slowing down a bit, which isn't necessarily a bad thing. Think of it like a really hot housing market that's finally starting to cool off. It's just normalizing. The government's latest report on job openings shows that in July there were about 7.2 million jobs available across the country. Now, that's down from June and a little lower than what the experts were expecting. We're seeing fewer openings in places like healthcare and retail, which tells us that businesses are being a little more careful with their hiring. One of the interesting things they track is how many people are quitting their jobs. When people feel confident they can find something better, they'll often quit without a new job lined up. The number of people quitting didn't really change, which could mean people are feeling a bit less confident about jumping ship right now. Job openings have been on a bit of a roller coaster. They hit a peak back in March of 2022 with a whopping 12.1 million openings. That was when the economy was roaring back after the COVID-19 lockdowns. Since then, the number has been steadily dropping. A big part of this slowdown is likely due to the Federal Reserve raising interest rates multiple times to fight inflation. When borrowing money gets more expensive, it can slow down the whole economy. Looking ahead, we'll get new numbers on Friday for August unemployment and hiring. Experts are expecting to see a small improvement, with businesses adding around 80,000 jobs. While that's better than the disappointing numbers we saw in July, it's still a sign that the job market is leveling out after a crazy few years. This slowdown in hiring is something to keep an eye on because it can affect how people feel about making a big purchase, like a home. When people are feeling a bit of uncertainty, they might hold off on major life decisions. But don't worry, even with fewer job openings, employers aren't really letting people go either. It's more of a cautious pause than a panic. As one economist put it, for the first time in a while, there are fewer jobs openings than there are unemployed people looking for work. This just shows that it's a little tougher to find a new job right now compared to the past couple of years. We'll be keeping a close watch on these trends to see how they impact the housing market and our clients. We'll chat again soon. When the job market slows down, it gives the Federal Reserve a reason to lower their interest rates. Thinking is they want to keep the economy from slowing down too much. So by lowering interest rates, make things like mortgages a little cheaper for us. This is big news for anyone who's been waiting to buy a home because lower interest rates can make a real difference in your monthly mortgage payment. So keep an eye out for an announcement from the Fed this month. Looks like a rate cut is very likely, and that could be a great thing for your wallet. Now I wanted to talk about some good news that's been happening with the mortgage rates lately. They've been coming down, and that's a really positive thing for anyone thinking about buying a house. So the average rate for a 30-year mortgage just dropped to 6.5%. That's a small change from 6.6% just last week. While it might not seem like a huge difference, every little bit helps when you're talking about a new home. A year ago, that same rate was at 6.35%. The cost of 15-year mortgages also came down a bit to 5.6% from 5.69%. These shorter-term loans are often used by people who are refinancing their current homes, and this is a great sign for homeowners too. In fact, with rates easing up, more homeowners are now looking into refinancing. Almost half of all recent mortgage applications were for refinancing, which is the highest that number has been in a long time. It shows that people are feeling more confident about making a move right now. You might be wondering why these rates are changing. Few things play a part of it. The Federal Reserve's decisions about interest rates have a big impact, as do things like what bond investors think is going to happen with the economy and inflation. Lately, people have been expecting the Fed to cut its main interest rate pretty soon. This expectation has been causing mortgage rates to slowly go down since July. This is a similar pattern to what we saw about a year ago when the Fed cut rates for the first time in a few years. That's when the 30-year mortgage rate got as low as 6.08%. Just to be clear, the Fed doesn't directly set mortgage rates, but when they make changes, it influences what investors do with long-term government bonds. Lenders use these bonds as a guide when they're deciding how to price home loans. So it's all connected. The bottom line is the current trend is good news for anyone looking to get into the housing market or for those who are thinking about refinancing. Right now, the average rate for a 30-year mortgage has dropped to its lowest point in a while. We're talking about the lowest it's been in about 5 months. This is mainly because people in the financial world are getting really excited and are betting that the Federal Reserve or the Fed is going to cut its interest rates very soon. Big news that started all this buzz came from a speech by Jerome Powell, who's the head of the Fed. He spoke a few weeks ago, and everyone was listening for clues about what the Fed might do next. What he said was kind of a big deal, especially to those who follow this stuff closely. Powell talked about the job market. While the number of new jobs being created has slowed down, the number of people who are unemployed has stayed pretty steady. He mentioned that this unusual situation suggests that the economy might be facing some risks. This kind of talk from the Fed usually means they're considering lowering interest rates to give the economy a little boost and encourage businesses to hire more people. Now you might be wondering how low rates could go. While the Fed hasn't officially made a move yet, markets are so sure they're going to cut rates that they're already acting like it happened. Financial markets are now betting there is a good chance of a rate cut at the Fed's next meeting in September. It's only expected to be a small cut, just a quarter of a percent, but after waiting for so long for rates to drop, even a small decrease feels like a huge win. However, it's a good idea not to get too excited just yet. The Fed is really data-driven, and there are still a few important reports coming out soon, like the jobs report and the inflation numbers. The Fed will be looking at all of this new information before making their final decision. So what does all this mean for you and your mortgage? Well, mortgage rates tend to jump ahead of what the Fed does. As soon as there is a strong feeling that the Fed is going to lower rates, mortgage rates usually start to drop. We're seeing that happen right now. The average rate for a 30-year fixed mortgage has already fallen a decent amount in the last few weeks. But don't forget, the Fed's meeting in September will also give us their predictions for the rest of the year and even beyond. If they hint at more rate cuts in the future, that could cause mortgage rates to go even lower. As we wrap up, I want to leave you with this final thought. The economy and the housing market are not just numbers and charts. They're deeply personal. They affect where we live, how we build our wealth, and the stability of our families. Thank you for joining me on this journey. Stay informed, be strategic, and I'll see you in the next one.